All right. Well, thank you very much for the opportunity. And again, as you kind of shared up front, there's a lot of great stuff to look at today. And I just want to give a shout out to The Millionaire Next Door. It changed my life, and William Danko, when I read that many moons ago. And I must have read that 20 times, probably, kind of read it every year or so. So William Danko, you've changed my life. So just so you know, Tom, just looks like I'm going to be presenting my slides, but it also has me kind of monitoring waiting rooms. I'm not sure if I can do both at the same time, given I'm a host.
Yeah, well, if you don't mind, just it's kind of a pain in the butt, but just hitting admit all once in a while.
Oh, sure. How do I do that? You admit all. Oh, okay. I can do that. Done.
It's a lot of power you have right now.
Yeah, sweet. Awesome. All right. So hopefully everybody can see that now. I will move my picture out of the way. So again, the whole goal of this, folks, was to try to give you 20 minutes of content and then open this up for questions. So that's what we're going to do. Again, my name is Michael Zuber. I'm author of One Rental at a Time. And as you will see, I have 3 slides of content. They will build. We will talk about them, and we will, really, hopefully, allow you to do a lot of amazing things. So hopefully this works. Yes. So as we get started, I want you to know who I am, right? Who was I in 2002 when this journey of buying my first rental home was? I was a, frankly, burned out stock market investor. I had successfully, in the dot-com craze, turned a whopping $7,000 into $200,000, ultimately losing most of that as some bets went against me. I got cocky. I stopped doing the work. The market rolled over, and I was caught in that with a lot of folks. So while my trading account once said $200,000 or nearly $200,000, it quickly fell to $40,000, and I felt defeated. Next up, I don't know about you, but a lot of the real estate investing books that I read said invest in your backyard. I can't remember how many books I read said you must invest 30 minutes from home. Well, I live in Mountain View, California. Probably at this time we were actually in Cupertino, California. And to say the Silicon Valley is ridiculously expensive and doesn't produce cash flow would be an understatement. So I, first off, lost a bunch of money. Then I wasted a year looking in the Bay Area. What next happened is $40,000 is what we had left, right? 190 minus 150 lost equal $40,000. All of that money was gone in my first 3 purchases. And, what happened there is we used $20,000 on the first one and then $10,000 on the next 2. So how the heck can we keep going forward? Okay. Next thing we did is we did what was called a cash out refis. We refinanced the first 3. That allowed us to produce more capital, ultimately taking us from 3 to 8 properties. The problem is these 8 properties or 8 homes took us to the peak of the market. I start my buying in 2002, and now it's 2006 or 7, and the market is nuts. The first house we bought, Norris Drive, which we talk about in our first book, we bought for 107, is now trading at 265. It doesn't cash flow because rents haven't changed. We went to a real estate meetup a lot like this one, and the guy speaking introduced us to a 1031 exchange and small apartment buildings. So that is what we did. That's how we moved forward. So we survived, right? Our houses, we were out of houses. We were in apartments. So we went from 8 units to 80 with no new capital. As the market rolls over, you quickly find that banks have the money. Banks make the rules. We were real estate investors. We're sitting on a portfolio of 80 units. It's probably 2008 or 9 at this point. And we're still trying to buy, right? We're not done. But banks were telling us that we were evil, frankly. They made us feel bad because we were real estate investors. So they didn't want to loan to us. So we found hard money. Yes, we paid 12% interest and 3 points. We were doing Burr and writing about it originally on Bigger Pockets before it was a thing. I was at the time a featured blogger on Bigger Pockets, writing about it, and spoke at their first event in Denver all those years ago. And then we ultimately rolled to private money. Private money was a lot cheaper. We paid 10% interest and no points. And we had private money lined up because we were telling everybody what we were doing, and they were scared of investing in stocks and buying real estate. So it was a big part of our journey. Lastly, I want it to be said, unlike some of the people on social media, we had no joint ventures, no syndication, no partners. That means when Olivia and I talk about 200 units, it's our units. It's not, hey, we own a 1,000-unit apartment building and have 1% of the deal. These are ours. They've always been ours. We chose not to JV or syndicate or have partners. It certainly slowed us down, but also it was just our risk profile and what we were doing. So this is the end of slide 1 of 3. Next for us, what were the keys to our success? Looking back over it is we wanted to buy and hold forever. We were not into flipping or wholesaling or any of that. Those are jobs. Those can produce high income. We were busy tech workers. Both Olivia and I worked. We both made 6 figures. And, we were busy enough. We did not want a new job. And, the last thing we wanted to do was have, take more time away from raising our family, which is, again, we were married and we were raising our daughter, Teresa. So we wanted to buy and hold forever. But as you will see, we did those 1031 exchanges. When people want to overpay, we will sell or reposition capital. We were first introduced to the affordability index. If you were in California or been in California investor for the last decade, you probably have heard of Bruce Norris, or maybe you've heard of his company, the Norris Group. We went to events just like this 12, 14, 15 years ago. Bruce Norris had created a series at the time called the California Crash. And I was at the event. I was heavily invested in California single family homes, and Bruce Norris scared me. I recently interviewed his son, Aaron Norris, talking about California Crash 2.0, and we just don't see it because of, lots of factors. But yes, the California Crash scared me. It is what kicked me over and allowed us to sell homes at the peak and 1031 into apartment buildings. Another thing is we stayed in one market. A lot of people say, what the heck are you doing investing in California? Why didn't you go to Texas or Ohio or Michigan or Florida or Alabama or on and on and on and on? And what I found was it was really hard to build teams. We actually fired the first 5 teams that we found, and ultimately finding a team that we counted on and needed and respected. And again, I could very easily be on 3 different continents during a week. So I didn't want to build another team, and it was just too hard. Something else we did is we never stopped looking. We always feel that it was always a great day to buy a great deal. So we just kept going. And, we were buying all the way down. We bought in 08, 09, 10, 11, 12. We didn't know where the bottom was. We just kept buying great deals. And we still look today. We just closed a duplex last week. We're looking to build an ADU now. The beauty about real estate investing is it's a skill, as you will see in a minute, and you can just keep going forward. So we plan to never stop. We are still growing, as we just said. We will always do a great deal. We're looking to buy now. We did 6 deals last year. We've done a couple this year, and we'll do several more next year. I am actively marketing. People are always wondering what we're doing now. Is I'm actively marketing to real estate owners who have owned their properties for 20 years. I'm offering to buy their entire portfolios. I'm suggesting seller financing to reduce taxes, maintain income, reduce headaches. But yes, I'm looking to go much, much bigger. And right now I've just dropped some mailers out to anybody who's owned property in my market for greater than 20 years. And I plan to hit that list several times over the next couple of months. Lastly, this is something I failed at. Real estate investing is a people business. Your tenants are people. The people who buy your flips are people. The people who are part of your wholesale and realtors and inspectors. And it is an entirely people business. Don't make the mistake I did. I spent the first 5 years living inside Excel when I should have been networking. My network at year 3 or 4 was terrible. I maybe had 1 or 2 agents. I should have had 100 agents. Keep growing your network. Keep telling your buy box. Tell everybody what you're doing because you just never know where those deals were going to come through. 2020 was the hardest year to buy deals as someone who bought out of the MLS because there was no inventory. The 6 deals that we closed in 2020 was because of our network and because we tell everybody what we are looking to buy. Next, bad things happen. I wish I could tell you that real estate investing was all unicorns and rainbows. It is absolutely not. There will be bad days. We have had tenants lie to us. We had an eviction in our very, very first rental, which would have crushed most people. But we reviewed the process and we just kept moving forward. This is something that you just need to realize. Bad things will happen. We've had fires, we've had floods, we've had contractors steal from us. We've had all kinds of bad things. You got to take your lumps and keep going. Always and never forget, buy and hold is about wealth creation. The cash flow that comes feels like a drip and then a trickle and then a flow and then a raging river. But it is absolutely without question wealth creation. If you watch my channel on YouTube, I've done a lot of videos about 50 years of research, and I do think we are in an inflationary decade. And if that's the case, you want to own hard assets that go up with inflation, especially if those hard assets produce income, i.e. cash flow. Get your money right. One of the big things that I got, again, from the millionaire next door, William Danko, you will be hearing from in a minute, is you got to get your money right at the beginning. And I freely admit time and time again that I was horrible at this. At 30 years of age, I had a great income and I was an under accumulator of wealth, a UAW. And that was frankly stupid. And but what we were able to do very quickly is we were able to, in a matter of 18 months, go in and become, take our expenses from 100% to 50. That accumulation of extra cash flow allowed us to save down payments more. As cash flow grew, we were able to save more and we were able to grow our portfolio. But if you don't have your money right at the beginning, you are kind of rowing in a very leaky boat. And at 30 years old, my boat had lots of leaks that I had to eventually plug up. I call them needs versus wants. Take care of the needs, but let's delay the wants. A lot of people get into real estate investing without getting your money right. Oh, it's a lot slower if you don't have your money right. One of the big things I've now come to realize that we did well, I did not appreciate this until other investors brought it to my attention, is we were able to recycle capital. We talked about very earlier on slide 1, going from 3 to 8. That was all recycled capital. That was cash out refinances. That same 40 grand that we had bought 3 properties with ultimately becomes 8 properties. And then we recycle capital again when we go from 8 to 80. We do all of that. We go from 3 to 80, no new capital. It's all cash out refi or 1031 exchanges. When you recycle capital, you have to get in the game, and then time is your friend. Again, we talk about going from 0 to 80, but you got to realize that was years in the making. And you've got to get in the game, which is what we did with the first 3. And then time just helped us, right? We bought 3 properties in about 2.5 years. We go from 3 to 8 in about a year and a half. And then we go from 8 to 80 in about a year and a half. It's just time is your friend in an appreciating and inflationary and market. One of my biggest things that I believe at my core, and it's why now I talk to other investors, is real estate investing is a skill. You are not born with it. You are not naturally gifted. You are not, you can't run faster, jump higher, lift more weights because of some God-given gift. Real estate investing is a skill. And because it is a skill, every single one of you could learn it. And because you can learn it, you can get better at it with practice. To me, it is a golf swing. You just got to practice, practice, practice. And then once you get good at it, take your golf swing from the Excel spreadsheet to the market. For me, from the driving range to the golf course. Again, real estate investing is a skill. Finally, you hone your skill with focus and daily discipline. I believe too many new real estate investors don't focus. You say things like, I'm going to invest in California. Well, gosh darn it, California is too big, right? I'm going to invest in Texas. Same deal. In Ohio, same deal. I'm going to invest in Huntsville, Alabama. Still too big. You've got to get hyper-focused. And the best example I have is my hyper-focused first year was Fresno, California, 93703, specific zip code, and a specific size house, 12 to 1,500 square feet, and 3 or 4 bedrooms. Focus. And then you got to look every day. I still can't believe people argue with me. They say, you know what, Michael, I don't have any time Monday through Friday, but I'm going to give you 4 hours on the weekend. The real estate market moves a lot faster. If you only are looking on Saturday, you are getting incomplete information. And again, to use an analogy that I hope hit home, can you go to the gym every Saturday and get a six-pack? Generally speaking, the answer is no, right? It takes focus and daily discipline. I ask for 20 minutes a day. That's what I want you to have. And again, I ask for that because I've done it. I traveled 1,000,000 miles. I stayed in hotels 100 nights a year. I, raised a family, and I learned a market that I never lived in. So I know it's possible. And then finally, a couple of last slides. I did write this book. This book, One Rental at a Time, was referenced in my bio or my intro. It is our story, 15 years of buy and hold, started in 2002 through the peak and the crash, the good, the bad, the ugly. It's had over 1,000 reviews on Amazon and Audible. And then just this morning at 5:45 a.m., we released the second book. This book was written for you. The first book was written really for me. The second book is for you. I've taken 15 conversations from my YouTube channel, One Rental at a Time, and put them out there. It's Burr, out of state, just different walks of life, people that started from different directions. And now you can really hopefully get inspired. And this book was really inspired by Gary Keller. Gary Keller wrote a book called, I think, The Millionaire Investor. It's blue and white. But inside that book, there are 20 stories, I think, at the end that I looked at for years just to keep motivated. So this book is kind of a shout out to Gary Keller, just more details. It's 15 different conversations of investors who struggled and triumphed, all different parts of life, all different careers, young, old, full-time, part-time. It is kind of a passion of mine. So I'm just released today. And then lastly, wrapping it up, One Rental at a Time works. It not only has worked for me, but it's worked for thousands of students, and I talk to, 10,000 people a week, hear about it on my YouTube channel. And I love the opportunity to give back. So with that said, hopefully that's 20 minutes. And Tom, we can take questions and you can take back control, or do I give you control? I'm not sure what happens next.
Yes, sir. Can you hear me?
I can.
All right. Awesome. Yeah. So you should be able to look into your chat here, Michael. Any kind of Q&A. What do you see?
Okay. I don't know. Oh, look at that. I nailed 20 minutes too. Awesome.
By the way, as you're doing that, how many videos a week do you put out on your
I average 5 a day.
5 a day.
5 a
So
day.
if you want real content that's not fluff and baloney,
yeah, it's real stuff.
that's what you subscribe to.
Thank you. I appreciate that.
Yeah. So what do you have for questions?
So I have one content. It looks here. Somebody basically saying it's hard to find deals, mailers, all of that. So again, I'll touch on this. 2020 or 2020. It was really all off market. So I bought from wholesalers, just to put a fine point on it. Actually, 5 wholesalers and an agent, right? One of them was an agent who brought me an off market deal. I'm doing mailers now, direct to owners. But I look every day in the MLS. I built my entire portfolio out of the MLS, and I won't stop. That history, that DNA, I looked this morning already. I won't stop. The real estate is a market that moves, it ebbs and flows. And just in the last 90 days, I have seen more inventory. I've actually written offers, more offers in the last 60 days than I did the previous 60 days. I'm always looking to grow. I will never stop looking at the MLS. I've seen more small multifamilies, dupes through quads on the market in the last month or so. So I won't stop that. But yes, I am doing more things like mailers and wholesalers. And I have a whole office building in Fresno called The Hub. So I'm not shy. I'm not done growing, to that question.
Awesome. Our co-host Mitch wants to ask a question.
Sure.
Let's see here. Mitch, you should be unmuted.
Michael, thank you. Yeah, great content. Actually, that was the question that I had, was the one that you just read off. So, cool. How difficult it is to find deals that are, with the MLS, because the competition is just pretty savage.
Yes.
The market, you might find something that works from a numbers game, but you're going to get into this, multiple bidding situation. And, that can be a challenge in itself. And I'm sure you've probably lost a few hairs there. But let me ask you this,
Sure.
What do you specifically look for on the MLS? I mean, what type of numbers are you looking at because you want rentals? Are you looking at discount cash flow? And not to get too technical, but I think everybody needs to, understand what discount cash flow looks like. But,
Sure.
Tell us a few things that, are of interest to you when you look at the MLS.
Mitch, you are clearly a Wall Street numbers guy. I love it. And I actually break down my what I look for very simply. I try to turn every rental property I buy into a bond. And as you know, bonds go by yield. So what I tell people to do and what I've done is I try to figure out what an average is in my market. So if I go back to 2002 when I was buying Norris Drive, the average deal in my market was 7%. I don't know about you, Mitch, but I have zero interest in average. It just doesn't, I don't like average. So once I've spent the 60 or 90 days figuring out average, and in some markets, let's be clear, like some people follow me and they're in San Diego and they're like, damn it, Michael, my market average is 1%. Well, first off, congratulations on knowing that, right? I'm not here to judge 1%. Maybe you have to invest in San Diego because you want to drive to your stuff. I don't judge, right? Or you want to go out of state and you want Ohio because you can get 10, 11, 12. But for my market back in the day, it was 7. I didn't like average. So my idea was to try to find 9 or above. And that's what I do. And how do I calculate yield? It's very easy, right? The numerator is the expected yearly cash flow. So you just do the math, rent minus all monthly expenses. Yes, reserves. Yes, property management. To all of that, it's real net cash flow. I don't count tax advantages. I don't count mortgage pay down. I want to know how much money comes out of my account and how much money goes back in. And then the denominator is going to be how much cash did it have to come out of my account to secure that asset. So obviously down payment, obviously closing costs, but I also include make ready. And this is something I talk about in my original book was a mistake. I originally was focused on cheap. I wanted to buy junk. But the unfortunate part of this is I wasn't including the cash to do make readies or repairs. And what I really quickly realized is I'm burning cash in a market where I could have got a better yield buying turnkey. At the time, turnkeys were hiring better yields because I could finance the repairs. So that's not always the case, but it certainly was the case for me early on. So in essence, I don't look for discounted cash flow, IRR, cap rates. I just want to know what the yield, how hard my money is working. And I want every deal to stand alone. I don't want to say, hey, I'm going to take all the cash flow out of this, turn it into an alligator, but it will be made up by these other 2 deals. Every deal must stand alone. Those are my 2 thoughts on deals and yield.
Awesome. Hey, let me have some questions here from John. Looks like, let's see, he started in the Bay Area, but was implying to go elsewhere, then said focus on a zip code. So basically, I think let's maybe add a minute of clarity as to how you look at markets and, really nail that whole focus mindset.
Yeah. So the first thing, right, I mentioned early on, I followed all the books in 2002 that said invest in your best backyard. I didn't know any different. So I tried. And if you're in the Bay Area like me, it doesn't work. If you're in the Bay Area, you gamble. You bet on appreciation to make up for any negative cash flow. My accounting brain would not allow me to do that. So I had to go somewhere else. So first thing for me was, do we go out of state or not? For me, out of state was not a non-starter because I hate airplanes. Like physically, I'm afraid to fly, but yet I still did 1 million miles for my job because it paid well. But I was not going to get on a plane to go see my stuff. For me, out of state wasn't an option, which meant then I had to take a California map and say, where could I drive? And Fresno was the first market, greater than 500,000 people, that offered a positive yield greater than 6%. So that's why Fresno, that's why I started. That's why I stayed.
Awesome. And then we got one from, I think, Todd here. I'm a single family home investor looking to do a 1031 exchange. Any levels of, or any advice to Todd?
I would, in a market like we are today, the exit is going to be the hardest thing, meaning the buy on the other side. I would start looking now, because the 1031 exchange is very rules based. You have dates. I think look them up from memory. I think it's 30 days to identify and 6 months to close, something like that. I would start looking now, right? Because again, it'll be in a market like this, it's really easy to sell a house, but it's hard to buy the return. So I would not wait to start looking.
Yeah, and I would add too that you don't. There's this whole idea of like for like doesn't necessarily apply. You can take a house, go into land, or a house into a fourplex. There's a lot of options into that too. So
yeah, I did houses into apartments. I think I did anywhere from 1 to 5 to 1 to 18. Yeah, yep, absolutely. Exactly. Like kind.
Here's one. My wife and I love everything about being a landlord except repairs.
Sorry, that's a good one.
Based on your experience, what are the best ways to keep repairs down?
Oh man, one of the things that I've learned after the years is don't do band-aids. In the beginning, I again freely admit to being cheap. I was focused on the nickel and not the quarter. I did a lot of band-aids, and band-aids don't work. Right, when a roof starts leaking, replace the roof. I can't tell you. I must have patched the same roof 5 or 6 times, and it's just a money losing proposition. Don't do band-aids is my best answer. And it's a mistake I freely admit to making.
Yep. Yeah. Yeah. Agree. I mean, I would say, I started, buying properties, just looking at the cash on cash return, not caring about the quality of tenant, quality of the market, all that. So, where I focus today is B plus properties and above. And really, I interview my own tenants. So I do self-manage through Hemlane, but I make sure I get the top quality tenants that will take care of my property. So that's a way to do it too. What tools do you use to estimate rents?
I don't use any tools. When I started doing this, folks, you had to pick up the phone and call people. So I built up a really good network of agents. I know there's Rentometer and all these other Craigslist and all that stuff today. I have such a history out in my market. I don't use anything. And the other thing to realize today, rents are exploding.
Yep.
Rentometer is okay, but it was okay in 2020. It is way off now.
Yeah.
Well, I mean, it's off by double digits.
Rents lag prices.
Yes. Prices race first, rents race second. Right. Man, I've been doing this a long time. I have never seen rents like this. Yeah. I've had tenant turnover, and I've had rents go up 25% from the tenant that left to the next one, pretty repeatedly.
Yep. Yeah, it's crazy. All right. Well, it looks like there's another question, but it's more tax related. I would say let's say that for Brandon Hall. He's
for me.
Guru. And then Michael, it's always a great time with you. And again, everyone, his book is actually it's one of the best sellers now in real estate. Run out of time, and his YouTube channel has grown substantially. I'm always amazed how fast you're growing that channel, but when you're doing 5 videos a day, I guess that makes sense.
There you go. Thanks for the opportunity. I look forward to coming back at about 3:30.
Awesome. Everyone out there, we'll take a quick 5-10 minute break, and we'll come back and we'll go over the crazy market of land development. So cool.